Hello, hello.
Let's see if this actually works. Well, Aaron's in here now, so it suggests that it's working.
Yeah. Do you want me to admit him in so then he can be a mod too?
Or as in add him in.
Yeah. Or because that's flips, right? Yeah,
You
that's if
can't
he wants to be a
you
mod.
won't be able to make him a co-host because he's not set in the invite. You have to do it beforehand.
Yeah, yeah, got it. All right, we'll do it for another time.
Yeah.
Recording is on. 16 participants in.
Okay, so let's hope when Dutchy arrives, it doesn't auto kick people.
There we go, he's in.
Wait, did anybody get kicked as soon as Dutchy joined?
No, more people are joining.
Right, okay. Oh shit, I just realized this is on my personal Instagram. Fuck's sake. Okay. Wait, am I sharing my screen yet? I don't even know.
No, you're not.
Wow, I was on mute, speaking to myself there for a sec.
Right, okay. Okay. How many people have we got in?
20.
22. All right. Yeah, we can just start. We're starting late, so I'll probably have to end late anyway. Get some nice intros going, get the trading blood flowing. Let's do it. Let's
Shall I
in,
let him in?
yeah, let's let them in. Let's have some fun. Let's have some fun. Let's talk
What's
charts.
good? What's good? Can you hear me, guys? Just asking.
Yeah,
Okay, got you.
loud and clear.
Or should they be able to be on mute?
Yeah, everybody respectfully mute. We will answer questions and etc. Just so the quality of the call is good, right? But we will answer questions and stuff, so don't worry. It's just so we don't the subtitles come out clear for people that need it as well. So appreciate you guys just keeping it stream for a little bit, We're gonna chop it up in a minute once everyone's in. I think that's pretty much everyone. No? What we have expected, what, 34, and we've got 25. Should be enough. Let me just double check. I haven't done this wrong. Oops, wrong button. I did not mean to do that. Okay, event. Yeah, 30 people. We've got 25. That's good enough. All right, cool. Welcome, everybody. Right. So we have Lowdown Liquidity. It's been a while. We've gone through some stuff, but we're back and we are going to chop it up. We've got 2 weeks of price action to get through because we didn't do one last week. Because a lot of people were wondering also last week why my bias was short. So I want to explain that because it's a pretty cool analysis in my opinion, and it was a high probability trade when you break it down to with the data, as well as this week's price action and why my bias today was wrong and why I should have definitely got into this move with the data, which I'll explain with PTLR as well. But the main thing I want to address in this call is, well, three things. One, understanding probabilities, because that helps in your decision making, because trading with the data isn't as rigid as you think. Meaning, like, just because something is, let's say, a lower probability, doesn't necessarily mean it's impossible, right? So, you have to be able to adapt to market conditions. So we'll address examples of that and touch upon that. One of the other things also is, which I keep saying, using the data to tell the story of price action, not write the story. So in context with the price action we're going to review today, we're going to talk about that too. And another one that I feel needs to be talked about that a lot of people struggle with, in my opinion, as well as myself. I mean, it's the hardest part of trading, in my opinion, which is, your high time frame bias, your daily bias, your weekly bias. Like it will never be mechanical. So don't think that there's like some sort of like source that I've been withholding. I'll show you what I do, but like I said, determination of the daily bias and weekly bias will always be somewhat discretionary, but we can make informed decisions based on the fact we trade supply and demand and we know where to trade from. Meaning if you know you're on a weekly supply, you probably should be looking for a bearish bias and vice versa. So it's not like, impossible to do. You guys have been, especially if you come from supply and demand already, you guys have been doing it subconsciously. It's just that now with the way that this strategy is created or the framework of the strategy, there's more of a focus on daily bias and weekly bias, mainly because on any given day, the objective of the day as a day trader is, if you know your daily bias, let's say, is bullish, you're trying to get in as close to this wick as possible and exit at the top, right? So that's the reason why there's so much focus on it and why everyone is only realizing now that they need to have daily bias. Whereas before, you're trading 1M patterns in no man's land, you don't really think about these things. So that's not throwing shots, that's just the truth. So we are going to address that today as well. But that is then at the end of the call, we will do Q&A as always. And yeah, it's all, like I said, it's all about giving value to you guys, making sure that you guys gain value, get to profitability, get to your goals, and ultimately, as we're all chasing financial freedom, live the life we want to live, right? Does that sound good so far? Let's see what the chat's saying. What's the chat saying? Okay, cool. This is going to be lit. So, my charts have changed a little bit since the last Lowdown Liquidity. Been playing around with some stuff, adding some stuff, not changing the strategy at all. It's just things to make things easier for the community based on the feedback that I've got. So, like, one thing you'll see is this moving average, which I'll explain in a minute. And then the other addition you will see that's new to my chart is this, ICT kill zones. So we're going to break it down step by step. Okay, I know what we'll do. The way we'll structure the call, I will go over the PA of the last 2 weeks. So because I need to explain this trade, because this trade was a monster trade. And I was in it, as everyone knows, and I need to explain why. And then in passing, we'll cover all the topics I've aforementioned before. So let's start. So why was my bias bearish? Why did I look to trade from here? And how did I use the data to come up with the edge to be able to not only get into the longs, but also get into the short and get out at the right time? All based on data. So I'm going to explain this today. So this idea all stemmed, believe it or not, from the monthly time frame. Now, I'm going to explain. So let's remove some of this noise for now. Right. So the monthly time frame. Let's remove this too. So the month of November, one thing that you'll notice when you're looking at the monthly time frame is, what do you see? Every single candle, more or less, has a bottom and top wick. So it's the same principle as when I talk about the weekly time frame. When I say I'm expecting the weekly wick or the weekly bottom wick, and the same thing with the daily time frame, where I'm looking to enter as close to the bottom wick or the top wick as possible, right? It's the same principle. So what happened in the lead up to 2 weeks ago, or I should say not 2 weeks ago, but last week, was we were forming higher highs. So let's split this into two. So the monthly time frame is here. And let's go to, like, let's say the weekly for now. Right. So up until that point, we were forming higher highs over and over and over again, right? So at that point, I'm like saying to myself, well, the month of November, as we keep forming higher highs, that means that there's no top wick. So I'm looking at it from a logical perspective. If I'm going to get a top wick, if not now, then when? Because it has to happen at some point. And we're in the last week of November. So it has to be this week. So my bias was I wanted to go short. But then the question became, where do I want to go short from? So then I start looking at the structure on the daily time frame. And I'm like, okay, well, Where was the last place that we broke structure that we saw the local sucker before structure broke? Which for me, I was like, well, this is a structure break. Oops, wrong one. This is a structure break, like so. Mark it out like so, as well as this. So I'm like, all right, what happened before all this shit broke, basically? Is the following. It's like, well, I can see a local sucker here, right? This swept liquidity before breaking structure. So I was interested in this POI. So I marked it out like so. And I was like, okay, let's say there's an argument that this hasn't been mitigated, this last up move. So I marked it out like this. I said, all right, when we get here, if it aligns with the fact that I'm expecting a monthly top wick, it will make sense for me to short from here. So I was like, especially given the fact that this had already failed. So at that point, I'm like, all right, I will look to short at the end of the month here if to form this top wick. So let me make that more clear for everyone. I'm looking for this. Oh, Jesus Christ. Okay, I kind of fucked that up. Hold on. Need to do it the other way. Yeah, put the monthly over here, put the daily here, and zoom in here. Right, so just to put things into perspective, this is what I'm talking about. Yeah, that's the top wick. So far, so good. Let's get some interaction in the chat. Make sure that everyone is right. Okay, so the next question is, like, you know, like I always do, is like, all right, I know what I want to do. Now I need to figure out with data, how am I going to pull this off? So the week starts off like so. So I already know where I want to short from for the week, and I have a bearish bias. Now, in the lead up to me looking to go short, what am I seeing? I'm seeing a demand chain, but I'm seeing an efficient demand chain. Or in one lens, you could argue that, okay, we have corrective price action given the fact that this chain is very efficient. So this means two things to me. This means, one, if at any point the chain fails, because it's efficient, I know that the intention isn't mitigation. The intention is liquidation, meaning all of this then will become IRL, right? Or sell side liquidity, whatever you want to call it, trendline liquidity, blah, 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 means money to me, right? And as you know, what we do here, we trade towards the money. So me seeing this price action, I'm like, this is a good thing. Let's move this for a second because I've already covered, you know, what we're expecting. We're expecting the top wick, so we don't really need to see that anymore. So the question now became, all right, in the lead up to this bearish week I'm expecting, but my POI is up here, I'm looking to go long. So all I'm looking for, as I'm trying to always answer the question in typical Blackwatch style, shout out to him, my mentor. I'm always trying to answer the question, who is in control, right? So, and there's a reason why I have this here, and there's a reason why it's in this order. So I need to know who is in control, meaning I need to see supply fail before I even entertain looking for a long, because I'm not going to try and long into active supply, right? Not what I do. So I ideally want this to fail. Specifically this because it's a previous New York high. And as you know, it's a clue for me in terms of order flow, who's in control, because usually previous New York highs and lows are respected. Let's put it 14. Right? So I mark this out and I say, okay, when this fails. But keep in mind, my routine on a day-to-day basis, right? I don't do anything until the Asia expansion. Like, to the point now where I'm actually following that rule religiously because I've got, every time I've deviated from that rule, I've actually paid a price. So I'm not looking to break that rule anymore. I'm trying to be good. So what time did this actually happen? Let's have a look. Yeah, closer look. Jesus Christ, is that? 7 and 5. Yeah, okay. So that actually counts, which is fine. Keeping in mind, I have a long bias. So, and then we have the previous New York low, which, like I said, is a good confluence for me for a previous New York continuation. Because that, when I have order flow like this, which I'll show you, trading can be pretty simple. Because one ICT concept that I'm aware of that I do trade is that they say the previous New York low, when you're trending, gets respected and you just retrace back to it. So what does that mean? So if you know the previous New York low gets retraced to and trace back to it, literally you can just be entering like this, as long as it meets PTLR, right? That's an entry. Previous New York low. So like that's an entry over here. Previous New York low. That's an entry over here, right? Previous New York low. That's an entry again. Same shit, same entry model, back to back to back to back to back. This is why I have weight on that idea, right? It makes it's like, this is so much easier and it's logical. And you see it enough to know that if everything plays out, it still respects PTLR, meaning if you know, for example, P is this, you know, T, time entered during kill zone, which is why I have this indicator here, which is why I suggest you guys get it. I'm waiting for it to arrive in one of these kill zones. And I already know so let's do this one by one. Let's just talk about this because I know there's been a lot of confusion with this particular continuation type before. So let me actually touch upon it real quick before I talk about this weak trade. Because there was multiple ways you could have got involved. That's the reason why I'm addressing this. But I want to show you how simple trading is, right? So you have a previous New York low, which I'm going to annotate. It's also a liquidity POI, i.e. the local sucker, right? Where is it? Cool, right? Liquidity POI. Why? This swept this and it broke structure. Liquidity POI. Liquidity POI, local sucker, all the things we like to see. Everything. A little arrow. So liquidity. Like so. And we broke structure. Like so. How do you want to draw this? Doesn't really matter. Right. So the last down move before the up move was this. Meaning, if you go on a higher time frame, that's going to be one candle. If I go on the 1 hour, that'll probably be one candle. More or less, right? You get the point though, right? This is the last down move. Now, when looking for our entries on the 15-minute and the 5-minute, if this is the previous New York low, like I'm saying, and you're looking to trade a continuation from it, you know that if this is protected, any movement back towards it is going to be a retracement. Therefore, a Fibonacci will work, right? And you also know through the lowdown continuation model, as long as you enter anywhere from the 50 and you put your stop loss on the red line, even though it's a 30 pip stop loss, you don't give a shit, you know you can get to 2R when you get to here and you go break even here. So you can take this on the high time frame structure and still align it with PTLR because you know that your entry model that you're looking to enter, if this is your POI, let's say, you're looking for it to be within the kill zone for PTLR because P is this. So let's just annotate it. P, Jesus Christ. What's going on here? Right, it's working now. It's working, cool. This is P. Now you're looking for it to arrive at P at the right time. So either Asia kill zone, which you wouldn't be awake for. So this doesn't count because you still need to wait for the Asia expansion before you do shit. London kill zone doesn't get there. So nothing to do there, but you have your expansion. So you can start looking for a trade potentially. But if you're long bias, you wouldn't be looking for that, would you? Because you're looking for a continuation in the first place. So then the last window of time you're looking for is New York, which you get here. So it wicks it, then you can say you maybe want to enter here. So this would be T. Then the question is, where is the liquidity, right? So if you make the argument that, okay, you've got trendline liquidity or something like this. And then that's your liquidity void or whatever you want to call it. Then you're looking to trade towards the money, like so. That would be L. And then is there enough range for you to get from here to there? That would be R, right? That would be PTLR broken down even on this type of structure, right? So the main thing that I'm trying to address here is the previous New York continuation is pretty good, but you still need to align it with PTLR. So meaning the next day, liquidity POI, same thing. What do? You're saying you're expecting a retracement from this low because this is supposed to be protected. So at that point, you're looking for an entry. You know you can't trade until the Asia expansion anyway. So what do? You don't do shit until one of these goes. Right? You wait. And you just keep trading the chain. And your POI that you want to trade from is here. And that's part of a demand chain. Then you say, okay, let's move this so you can see. All right, let's put this down. Hold on. I want to make sure people can see everything. All right, cool. Now it's in sight. So price / POI, check. Time entered POI during kill zone. Asia kill zone, check. Liquidity to target. I feel like taking the piss and being like, all right, cool, weak high, cool, we target this, whatever, right? Whatever. Or we look for trendline liquidity, ERL, whatever you want to call it, liquidity zone. Something along these lines, right? Then what do we look for next? This is a London kill zone trade based on FIP. It's a London kill zone. Could be either. You can enter in London and New York. So there's more. I'm showing you all the variations, right? No, I don't put no limits. I still trade London. I still trade London. I still trade New York. I'm gonna show you all the entries. Like, don't worry. You're not gonna miss anything, right? So what do we need? So the typical day routine is as follows. You have your POI you want to trade from. So let's break it down into steps. So no one misses a beat here. You have your POI you want to trade from. It's a liquidity POI, which is even better because therefore you know it's supposed to be protected. It's in line with the demand chain. So you know demand is in control. Demand in control, demand chain. You got corrective pullback, so there's a draw on liquidity here as well. All of this is just me helping myself tell the story in terms of like logically does it make sense what I want to do. It hits my POI at the right time. So P and T have been covered now. Any form of supply that was in control at any point fails here when I get the Asian expansion to the upside. So my first trade can be as simple as this. Now, depending on how I want to trade this, when I'm close to the wick, so in this given situation, let's put this in context so people can see. When I'm close to the daily candle wick, I like to cover it rather than take it as a continuation and put my stop loss here. Because one, I don't need a 5 pip stop loss. And two, I like to have the full statistics of everything because this is my A+ setup because I know the statistics of everything. I know the statistics of this holding. I know the statistics of pip availability easier because I'm covering the low of the day. So this is just easier for me to manage. And I'm less likely to get pissed off if this gets hit and then goes. But keep in mind, the probability of this getting hit on a legit retracement and carrying on being a retracement is only 3%. So I'm not really worried about that, to be honest. But I just like having the best protected trade, which is this. If I can get close enough to this, I'll cover it. If I'm too far away, then I'll use this, right? So the first trade is this, and you go break even like so. So first trade, as the London trader, you're in, good job, you're done, right? Then the next trade is for someone, let's say like Blakey, where, wait, hold on, what's he saying? In the last call, he put a fib from the low of Asia. It doesn't need to be a liquidity PY if I know it's the low of the day, because the same principle is the same. You need to draw the fib from somewhere that you know is protected. If you know that it's the low of the day, given the fact that one, this is a liquidity POI, it sweeps this before breaking structure, and two, you know that it's in the kill zone and it meets the story in terms of it's mitigated a demand zone. You have confidence to know this is the low of the day, therefore it should be protected. So you can draw a fib from this. Doesn't mean you take it necessarily as a continuation, even though it does work, but you can draw and enter continuations like this, which we've seen all week, and this is what we covered in the playbook call. So that answers that question in passing. Now, back to what I was saying. London trade, you're in, good job. You go break even, you follow the structure, right? No issue. Next trade. You can take a continuation again. So let's move this out of the way. Make sure it's not too cluttered. If you missed the first trade, you could enter in New York. Why? So once again, you still got arguably, let's say this supply, right? Now it's failed again. But from a local sucker perspective, why is this valid as a local sucker? So let me explain. If you get the red line that I love and you look left, at one point you can make me argue that this is still a supply chain. Like so. And therefore, when you have something like this and you've seen reactions to it and you see this break, you can make the argument that supply is still in control. Because someone could think that when this failed, as they thought it was efficient, if they were looking at this at the 1M time frame, you can make the argument that someone would say, okay, so let's just draw this like roughly. Because this broke this, that supply is in control, and then they're going to look to do this. Then when that doesn't happen, who's the idiot in drawdown? This guy. This last down move, as soon as this broke, they're in drawdown, and now you know supply is not in control. So this guy now, by definition, is the local sucker. So you can look to trade a fib from that, because this should be protected. So let's annotate that real quick. So in the event you missed the London trade that would have covered the low of the day, this is your second opportunity to get in. Like so. Then you know through the way that my fib works, as long as you enter on the 50, so that doesn't mean you have to set a limit here, but you want to follow a set process. Set process meaning you want to know where your stop loss is, S. You want to know where your entry is, anywhere between the white line and the yellow line, and you know where your take profit is, which you know through the fib, TP1, TP2, TP3, right? So with this being said, and the reason why you use the fib level here is because you're taking a continuation in the middle of a daily candle and you don't want to have a stop loss all the way down here, 18 pips. There's justification for you to use the fib now. But if I'm close enough that I can cover the low of the day, I'll literally just cover the low of the day. Because that's the best trade. That's the A+ setup. This is the A setup. So in this scenario, same thing. So you don't need to put a limit, but like I said, I market execute anyway, but because I already know as soon as I want to take this trade, I know where my stop loss has to be. It's here. So I don't get scared, even if I enter like this or enter like this. As long as it's more than 5 pips, and that's my invalidation point, I don't care, I get in. All right. And then you go break even here, TP1, TP2, and then you align this, right? you align this with optimal exit time because you know that, and this is an important point, you know that your exit window is between 3 and 7 o'clock. So a lot of people I see get scared and then they close like at 12 o'clock and etc. Right? And that's just purely because they're not looking at it from the data lens. And this, let me explain. So if you go to the data, optimal exit time, I mean, oh, I hope I'm on EU, aren't I? Great. Either way, okay, I'll just do it for the sake of the video. I'm gonna have to wait a little bit. This model is such a pain in the ass sometimes. Give it a second. But this is going to explain why you let your trade play out and you let it play out to at least 3 o'clock, right? Because you're going to see through the data, the chances of the high of the day being hit before 3 is pretty low, or the low of the day being hit before 3 is pretty low. So you're choking your trade by closing it early. Because it's why you need to be patient, basically. Because the data is telling you when to get out. So you closing early because you're scared or whatever, or is all psychological. And a lot of the time people close early because they're already in drawdown or whatever, and they're looking to recoup losses rather than just let the trade play out. You need to look at every single trade idea and every trade you do in isolation. Don't look at it like, oh, I've had a shit bunch of trades, therefore this one has to be closed at 2R. No, if this trade is a 3R or 4R trade, based on whatever the trade idea is, then you handle it accordingly. You don't go and say, because I took a loss in 2020, I'm going to now trade this particular trade in 2023 at 2R. Like, that doesn't sound like it makes sense. It sounds pretty stupid. But that's pretty much what you're doing when you close early. Because you're letting previous trades affect your judgment for this one, which has nothing to do with it. Right? So to my previous point, or what I'm trying to explain is the reason why we wait for the optimal exit time between 3 o'clock, which is the highest probable hour, and 7, is because we know from 3 o'clock onwards, there's like a 45% chance that it could be the high of the day. And from 7, it gets to about 80. Right? So why would you be trying to close trades at like 11 or 12 when you know there's still room to go? That doesn't mean, though, you can't partial. I'm just saying don't close everything because it's very unrealistic that the low of the day or the high of the day has happened at 12. Right? And just to illustrate this point more on terms of optimal exit times, which is why I have this indicator here, look how common the exit time is in this window. So this case, it works. This case, if you were bearish, it works. Bearish again, it works. Bearish again, it works. Bullish, it works. Bullish, it works. Bullish, it works. Bearish, it works. Bullish, it works. And so on. And so on and so on and so on, right? The data doesn't lie. This isn't bullshit. So I suggest you guys add this because it's pretty good, pretty powerful. Like what, 9 times out of 10, it works out. So, I'm using it. Just thought I'd share that nugget with you guys. Use it if you want. I'm definitely going to use it because I know it works. So, with that being said, to our previous point, so like I said, you have 2 trades here. There's different variations of the continuation model, but the only difference between a plus setup and a setup for me is the A plus setup is the HOD reversal, which was the first one we covered, which would have been this, where you cover the low of the day, because you know the statistics of this, right? And that doesn't mean, let's say you were a New York trader that just was super conservative. You can still cover the low of the day because you know it's 15 pips. So you know there's a high probability that you can at least get to 2R on EU anyway. And then if you did take this trade in New York at 1 o'clock, covering the low of the day, the probability of this at that time is a lot higher. And I'm going to tell you exactly what the probability is right now. So what that means is if you entered this New York trade as a LOD reversal, right? So let's mark this out here. like so. You enter this at 1 o'clock, right? And let's say your target was 2R for just educational purposes. And let's remove this fib for now, and let's manage this differently. Let's manage this like it was just a normal day trade, right? And we're like, okay, with a 15 pip stop, we're trying to figure out TP, well, all of these TPs, like how much R are we going to go for? But more importantly, the first thing we're trying to do is figure out if I'm covering the low of the day and I'm entering in New York, what's the probability of my stop loss getting hit? Or more importantly, what's the probability of my stop loss not getting hit based on this being the low of the day, right? So that's where we use the data, and we go up here. And at 1 o'clock on the bullish scenario, the probability of that being the low of the day is 85.2%. So this is a slam dunk setup at that point. So you'd write here 85.2% at time of entry. Now, I am aware that there's some people who have not seen me do this breakdown before, so I'm going to break it down slowly for everyone to understand how I came to this conclusion. Because I know I've covered it on some coaching calls, but I've never done it on a low down liquidity that I can remember. I mean, maybe I have, but I'll do it again anyway. So, how do we get to this number? Right. So, when this happens at 2:45 a.m., so the 2 a.m. hour, the probability of this being the Asia low of the daily candle, right? So let's do it. Is 32.4% at that time. As hours pass by, so 3 a.m., 4 a.m., 5 a.m. go past, and you're seeing this still hold, by process of elimination, you know 4 a.m. can't be the low of the day because it's done and this is still holding. 5 a.m. can't be the low of the day because this is still holding, and so on and so on and so on. So what that means is, hour by hour, by process of elimination, you can rule out 4 a.m. isn't the low, 5 a.m. is not the low. So the odds of this particular hour that we're looking at are increasing hour by hour by hour by hour, all the way until we get to our entry at 1 o'clock. Now we know at 1 o'clock, the odds of this 2 a.m. low is 85.2%. So now when you're looking to trade, you have confidence knowing that you, not only do you know daily direction because supply has failed like hell, but you also know your probability of this holding is so much higher. This is why you shouldn't really be upset being a New York trader, because you have a very, very big statistical advantage if you understand the daily time frame and the daily candle. So at this point, you're taking a 2R, well, we'll figure out what R you target in a minute, but you're taking a high probability trade knowing that there's an 85.2% chance your stop loss is safe. And you're looking to target based on what, a 15 pip stop loss. We'll see what you're going to target in a minute. 15 pips on a Friday, so it should be a lower day. You are looking to target between 2 to 3R. 4R is off the question because it's less than 70%. So between 2 to 3R at most. So stretch target would be this, and you'd be content depending on your exit window, which is what I keep saying. Depending on your exit window, you might have to settle for 2R. Exit window time, where does it get to? Where is our example? Right here. So exit window time, end of exit window, where are you? You're at 2R, so you close because it's a Friday and you're content. And that's it, you're done. Does that make sense? You're going to see how powerful this exit window thing is in this session, believe me. Do you have a checklist or criteria how you determine your daily bias? As mentioned, I have problems. Well, yep, we'll get to that because I still have to explain my weekly trade, right? So now we're going to touch upon, now that we've talked about continuations, timing, and et cetera, and PTLR, like usual, we'll carry on, right? So in the lead up to this week that I said I was bearish bias, what did we know? So how I start my day, Asia high, Asia low, I don't do shit until the expansion. But I have a previous New York low and I've got order flow. So I know bare minimum, I'm expecting something like this. But I want it to arrive in my I'm looking for it to arrive at my entry point in terms of PTLR, because my POI, I already know, is this last down candle. I'm looking for it to enter in one of my windows. Asia would be, this indicator doesn't work for Monday, so don't feel like something is screwed up here, right? Anyway. So in this, I'm not taking from the Asia low because it's not my POI. My POI is here. So for here, I'm looking at, this is my POI I'm looking for, and I'm trying, and I want it to enter my POI. Now, there is an argument to say, if someone did take this, they just got unlucky, right? Because if they said that this was the Asia expansion, and they looked to take the continuation, they were just unlucky and they took the L, and that's fine. But that doesn't mean that this still isn't valid. So if you did take that L and you did draw it from the Asian low because you were convinced this was a sweep or whatever, okay, cool. Eat the L. That's life. Nothing's 100%. But this is still valid because the previous New York low is still in play. And like I said, the overall trade idea, high time frame, you want to short from here. I'm not interested in any shorts here. So with that being said, you're still looking to go long. So until this fails, I'm still long bias. So you have options here, right? If, for example, so all entry models that I trade work more or less in the span of these 2 days. This is an example of where you could have used lunch money because you have your POI and it's arriving at the right time. T. So PTLR is relevant. You've got liquidity above this. And more importantly, you want to trade from here. So you know you've got range, even if you're looking to hold this for a couple of days, right? So if you marked out your day like so, you could have taken a lunch money trade because you would have marked out Asia range like so. And then if you're expecting this sell side liquidity to get swept, given the fact that it's at the right time, you could have taken a lunch money trade, which for those who trade ICT is similar, but not the same as a turtle suit. And then you'd exit at 2R. And you'd be hoping that you get to 2R in your exit window. You don't get there, which is not which sucks, but you would have been break even at this point anyway. So you could have held overnight. So there's that entry model. Or you just sack this off altogether and you're like, all right, it hit my POI, but you didn't really give me the entry model I want. Because if you wanted to enter like this with a LOD reversal, what would you need to see? You needed to see short-term supply fail. And the only supply that you see on the 5-minute fail is here. So unless you're willing to take a breaker like this, there was no way of getting in. His supply only fails there. So you don't need to just stop to be here. That would have been 20 pips. Then you have to ask yourself, do I have enough range? One, you don't take this trade anyway. Why? It's outside of your window. The red zone is an exit window. It's not an entry window. So this trade by definition is invalid. Anyway, I never get into trades in the red zone, ever. Not what I do. I might enter like here, but this late, I'm not looking to enter anything, ever. Right? So the next day comes, what do you have again? You got, this is a liquidity sweep and you got breaker structure. This is your previous New York low. You carry on playing the chain. So in the previous day, you can even argue it's not even a no trade day, right? And that's fine. You're not missing out on anything because you get a better setup the next day anyway. Like remember, the markets will always be here, but your capital might not be. So with that being said, previous New York low. So you can take a previous New York continuation if PTLR lines up. So let's do it like so. You wait for Asia expansion. You're bullish bias, so you're not looking to short it, like I said. You're bullish bias until your POI. Because right now you're just trading in line with order flow. And what are you doing? You don't do shit until the Asia expansion. There you go. You get it. Cool. Now you can take this in so many different ways, which I'm going to explain. So you're looking for PTLR. P is as follows over here. So we'll break down this trade again. Let me just get my annotation tool. Oops. Okay, is that working? I think it's working now. Yeah. All right. P T L R. Right? Everything you need to make this trade valid. So let's clear this up for a second and start annotating things properly. So London session, low of the day, occurs at what time? 8 a.m. What does that mean to us? Bullish bias, 8 a.m. That is prime time. That's what that means to us. So with this being said, prime time, perfect. Right? So you're looking for this to happen at the time. At the time of entry, at the time of low of the day formation, the odds of that being the low of the day is 59.1%. For you, if you're taking this like on the continuation model, like the previous New York continuation, let's say you're someone you just got bored, you don't give a fuck. You just enter like this, cover this. It's the same principle. TP1, sorry, break even, TP1, TP2, TP3, right? That's one option. But there's more. There's so many different ways you could have got involved here, right? You don't like this setup? No issues, right? You play it the LOD reversal way, where you're like, okay, that's my POI. I want a confirmation entry in this box. You want chalk in a box, right? Because this is a mini wipe-off accumulation. And all that means is you have efficient supply, proven, holding, right? This mitigates this and so on. And all you're waiting for is what? Your breaker. This reacts to this. So when this fails, that's your breaker. And you're convinced this is the low of the day because it's happened at the right time and you've seen your chop. So I'll do it manually because the algo is not doing it for me. So like so, you have chalk. Like this, right? Then at this point, then you're saying, okay, when this happens, you can either get in immediately. Why? Because at that point, you got your confirmation trigger to get in and you know your stop loss has to go here. And as I said before, you know that if you have a stop loss that's 15 pips or less, you have a over 70% chance on EU of getting to 3R from memory. Yeah, there you go. If I remove this, you have a 70% chance over 11 years of getting to 3R with a 15 pip stop. So you know this is going to be viable for you to get to 3R, which of course it does, right? Because like at the end of the day, it's all about making money. You don't give a shit how you do it, you just want to be in the blue. This 2 pip stop loss garbage to get 10 hour a day and all this other crap ain't real. Like it's not, it's hindsight analysis. You want to do something that is high probability and consistent. 15 pips from the low of the day is almost guaranteed to get you to 3R. Just want to stress that point again, because like I said, it's about retraining the mind, because all of us have seen social media and think that 20R days are normal when they're not. Right. Anyway, ran over. So you mark your tool out like so. When you're trying to figure out what's the probability of all your targets, blah, 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 and you get to 4R, whatever, right? So there's that option. And like I said, 3R, you hit it at what time? In your exit window. Again, stressing this point. You don't get scared because you're like 2R, I need to secure. Like, where's your exit window? So you have that there. So you can enter straight away on this, or if you are a New York trader, you get a continuation in the open. Because then you know by the time you get to New York, you know the probability of this being the low of the day is a lot higher. So at 1 o'clock, the probability of that being the low of the day, 85.2% again, right? So at that point, you're like, okay, cool. It also meets the criteria of it being at the 50%. So if you don't want to cover the low of the day, because, well, I mean, there's no reason why you wouldn't. It's like a 13.9 pip stop, so you know you can get to 3R. But even if you didn't, because you're like, it's far away for whatever reason, that's fine. You can still do this. This is still valid. Then you do the same thing, like always, mechanical way. Break even here, TP1, TP2, TP3. TP3 is 4R by definition. You draw this perfectly. I haven't drawn it perfectly, but you get my point. There you go. Right. 4R. And then exit window. 3 onwards. Boom. And you're done for the day. 4R. Good. Good job. Done. Don't over-engineer it. Don't do anything. Don't hold on for the moon because you end up giving back so much profit, right? The data says get out here. Pip availability says get out here. You get out here and you come back tomorrow. Because keeping in mind, you're looking to short from here anyway and you hit the zone. And you don't know if this week that is expected to be bearish, you don't know if it's going to have a Tuesday high. So there's no guarantee that it's even going to carry on going. Hence why you would close everything if you're expecting a bearish week. You wouldn't partial this because you are expecting a bearish week because of what I said before. This is supposed to be, well, and it ended up being the monthly high. And you're expecting a top wick. You're not going to carry on going up and up and up without, because that will mean you're not forming the top wick I spoke about at the beginning of the call. So finally, and this is why I took, I got into this trade. I don't think I got in on Monday, but I definitely took this one. And I closed the majority of it because I was expecting a bearish week. And I was just waiting for Asia to confirm it. So the next day comes and it's the same process for me again, where I say, don't do shit until this goes. But what am I seeing is Asia has a chalk in my zone. And I can see demand fail. So I'm like licking my chops. I'm like, oh, cool. This is gonna be an easy day for me. Because all I need is just confirmation that Asia is expanded, then I know I'm allowed to get in. Right? So Asia expands, and depending on how aggressive you are, you could have just entered like this and covered the high. But then you need a 20 pip stop loss. Which I did, to be honest. I entered both ways. I entered one like this with my stop loss here, because I didn't want a 20 pip stop loss as well. But I didn't mind the 20 pip stop loss because one, I knew this was the high of the day based on it's in my kill zone, it's a liquidity POI, and it's coming from a super high time frame daily and weekly POI. That's a local sucker. And it's in line with the idea that I needed a monthly top wick. So I had so many confluences saying I wanted to go short here. Then on top of that, how many days bullish did I get in the lead up to this day? 1, 2, 3, 4. So this was day number 5. So the probability of day number 5 being bullish is 4.1%. So there was a 96% chance that today was going to be bearish, in line with what I wanted to do already. So I'm like, this is a slap your mama, take the trade. Like, don't, like, just short it and close your eyes. Like, you'll be fine. Like, if you take an L on this, you didn't do anything stupid, and you use the probabilities and everything you had to your, you know, in your favor, given what you knew, right? So the question now becomes, all right, if you're expecting a bearish week, like so, and you're anticipating this is the weekly high, with you knowing this is the weekly high and you entering like this, and you know, whether you take it as a higher day continuation and you literally put your stop loss here to refine it a bit, or you just take it as a HOD reversal, up to you. But either way, with you knowing what this is, you now know, let's change this to entry. You now know with the data where the week is likely to end. So this is the weekly high, and this is in November. So now I use the data to forecast where the weekly low will be. EU November, average pip range is 190 pips over 11 years. So with that being said, I get my target tool, price target, and I drag it down to 190 pips. Like so. Well, you look at that. So a 20 pip stop loss doesn't look so crazy when your target is here for AR. And you know the day that's likely to happen in terms of hitting target is the most likely when? Friday. Because the weekly cycle doesn't lie. 16, 17 years consistently is skewed towards Friday. So there you go. Then, just to complete the education here, we're seeing something a bit, not a bit odd, but we still can adapt, where Wednesday is the weekly high. So when this is happening and you get this breaker, like, then what's the probability of this being the weekly high? This is how you would do it. It can't be Monday, Monday got taken. It can't be Tuesday, Tuesday got taken. So the probability of Wednesday being the weekly high is when you sum up all of these. So the probability of Wednesday being the weekly high is 84.7%. So when this breaks, you know the probability of this is 84.7% by process of elimination. So you know that the odds are high and in your favor for that to also be the weekly high, especially considering once this starts breaking shit, all of this demand chain now becomes what? Like I said at the beginning, IRL. Why? Because it was mitigated properly on the way up. So the intention isn't to mitigate anything, it's to liquidate. So all of it becomes liquidity. Hence why a 190 target in line with the weekly average makes sense. And that's why you wouldn't be like, oh, 20 pips is too big of a stop loss, because your target is 168 pips away. And then if you're someone who's working and etc., you can manage this trade easier if it's a 20 pip stop loss, because you control your stop loss easier, which I'm going to show you now. Because this is what I used to do when I was working full-time, when I had big stop losses. I'd be like, okay, the minimum target I want is 2R, so I'm not even going to look to do anything until then. I'm going to make this bigger because I think it's too small. Hold on. Okay. Everyone can see this, yeah? Just making sure people can see before I do the next step. Right. So this is what I used to do when I used to trade while working full-time in tech. So let's clear this up a little bit. So this is why I don't mind stop losses that are even 20 or 25 pips, because it's so much easier to manage. Because all I do, I put one line here and I call it stop loss. And I have another line and I call it target. So my minimum target on any trade is 2R. So, and I'm taking this on the weekly time frame, like I said. So I'm not bothered by all this noise. So until it gets, so in this case, I'm looking to, maybe I go break even at 1R, I don't know, but let's just say for argument's sake, I'll go break even here because I have faith in my weekly idea. Because if this fails, this will fail also because there's nothing to mitigate here, right? So 2R goes and then I go break even. Then what do? You put your next alert here. When it goes ping, you trail 2. When it goes ping again, then up to you. You either, if you trail 3, you get taken out, sucks for you, but at least you secured 3. Or you can do it in trading 2 intervals. Go here, lock in 4, because the chances of it retracing 40 pips is very, very low. Right? So this allows you to stay in the trade, but hold full volume. So that's a little tip if you want, like, depending on how you want to manage it. And that would be the only way you could have held full volume while protecting your profits all the way down, if you wanted to do that. So big stop losses are a blessing in disguise when you know what you're doing. So don't snub a trade that's based on a weekly idea because of 20 pips if you're targeting 160. And it's not like oh, why are you targeting 160? That's a bit far-fetched. The weekly average is 190. And it hit it to the pip. And you guys have seen me do this so many times. So it's not like me cherry picking or hindsight bias because I've done this so many times, as you've seen. That's how I come up with the idea. Now, you have the idea that you want to go bearish from this day from the jump. But that doesn't mean you can't just scale in on the way down to Friday, right? And you have the same setup appear 3 days in a row. If you know this is the high of the day, then by definition, it should be protected. So any movement back towards it should be what? A retracement. If it's a retracement, what can you use? A retracement tool. What is that? A Fibonacci. There's one trade. Same thing. If this is the high of the day and you're expecting a retracement and you wait for your age expansion, any movement back towards it should be a retracement, therefore Fibonacci. And there's a second trade. Next day, what do you expect? Same shit. Wait for your age expansion, get in. Here or here, doesn't matter. Same thing. 3 trades in a row, same entry. 3 trades in a row, same exit window. Exit or partial. Exit or partial. You would partial, why? If you're expecting a bearish week and it's Wednesday, why would you choke the trade if you know you've got 168 pips to go? You partial, you let the runner do damage. You partial, you let the runner do damage. When do you partial? You partial where you expect the low of the day to be. Where is that? The exit window. Partial here, take profit, everything here, exit window, because it's Friday, you're done. One, two, three, there's your FTMO, there's your month done. 3 shots. Next day, Monday, what do you get? Same thing. Day after, what do you get? Same thing. You know, entered in New York late and you still would have got there. And where's the exit window? Here, same thing. Here, same thing. Here, same thing. The only place that you got messed up is here. But if you took this as a previous New York continuation, boom, enter, exit. Then where I screwed up, right? And I'll explain my screw up. I screwed up here. And I know this in hindsight, but I can explain why I screwed up. So I looked at this at the daily time frame. And stubborn me, I said, okay, if I want to go long from anywhere, where do I want to go long? I was like, all right, cool. I'll go long from the last down candle. I want to go long from here, right? But this was the wrong way to look at it, and I'll explain why. Because if you look at this, so where did structure break? Structure broke right here. So from a weekly perspective, this is five candles. So from the weekly perspective, where is the real demand? Here. So what needed to get mitigated to expect a pullback was this weekly demand zone. That's what I failed to see. That was my mistake. Because then when you look at this on the daily, and keep in mind, and I'm addressing this point specifically for a reason. Whenever you're looking at this consecutive daily candle analysis, it doesn't mean shit if it's in the middle of no man's land. You need it to react from something to justify the pullback. Hence why, just because it says 90% here or whatever, like relative to what? There's nothing to mitigate here, right? So there's no reason why it's going to pull back here in the way I trade. I know there's an argument that, the ICT, blah, 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 encroachment, whatever this bullshit is, right? Cool. That's another justification for why you'd want to look for a long or this is a POI. But from a supply and demand perspective, you're looking at it from a weekly demand level, which is what you got. And you got it. And it really makes sense on this day because now the consecutive candle argument makes sense because it's at a demand level. It doesn't mean anything if it's in no man's land. Don't forget that. This is a key example of using data to tell the story, not write the story. So the story is you are looking for either a long or a pullback from weekly demand. Therefore, you're looking for confluences to align with that idea. Now you start looking at the data when you're here, i.e. the consecutive candle analysis, to make sense of a pullback or a long. So 1, 2, 3, 4, 5, 6. What's the probability of day number 7 being bearish? 0.9%. Sorry, other way, bearish. 1%. So there's a 99% chance today was going to be bullish. And then by, through the storytelling, like I'm saying, that it makes sense given that we're at a weekly demand. Now, with that being said, how would you have entered with PTLR? So, where's my pen? Okay, cool, let's do it. POI, big ass POI here. So we mark that as P. Like so. P. Everywhere. It's all this shit. Big ass POI. Right? So P. Then time. This happens in London, London Open, Frankfurt Open. There's T right there. Then what do you need? You need short-term supply to fail. It gets clapped here, it gets clapped here. Cool. Demand is down in control. Where is the money? Relatively equal lows kind of shit here, as well as the fact that you might want to look for a continuation short from here, because this is a liquidity POI, right? So there's justification for us to go up, along with the fact that we know there's a 99% chance that we're expecting a pullback from this POI, which is why I'm kind of annoyed I didn't see this, but this is why you end of day, this is why you learn. I'm always going to be a student of the game. So with that being said, where is your first entry? Possibility. So let's change this. So demand is holding here, so you can enter like this as a LOD reversal. Then you get more supply fail again over here. Gets clapped again. Therefore, you can look for another long as a, why is this pen not working? You can look for another long over here, right? So with that being said, let's break down the entries old school style. So let's make this bigger. 15M time frame, don't even need to go to the 5 minute for this. You look for short-term supply. There's your breaker. You mark out your standard deviation stuff. You wait for your Asia expansion. You get it here, you get it here. If you had the balls, so let's talk about all the entry models. You had the balls, there's lunch money right there. 15 pips from memory. How many standard deviations? 5. So 5 was potential. Didn't happen, but it was potential. 1, 2, 3, 4. So potential was 5. You still need to quantify that, so we don't go crazy, right? But you know, it being potentially 5, lunch money, you're guaranteed 2. You're guaranteed 3 standard deviations across, so you know that you're guaranteed 2 up. So your lunch money trade, this is covering 1, 2 R's guaranteed, there you go. If you wanted to stretch it, given the fact that you're not in your exit window, which is here, then you can stretch it to 3R, and there you go. So that covers lunch money as one option. You only take lunch money when you're in profit. If you're in drawdown, lunch money is off the table because this is a risk entry. Next trade, LOD reversal. So let's do it. Flip from here to here, entry, blah, blah, blah. Oops. Enter anywhere from the 50 to the yellow line, and you cover this because it's the low of the day reversal. Annotate it. So LOD reversal like so, and enter anywhere from here to here. So you could honestly you could enter like this. It's still over 5 pips, so that's still valid. 15 pips minimum break even, so you could go break even here, or you could go break even here to you. And you can still use the fib as targets or use pip availability. Either way, pip availability is the best way because you know it's the only statistical way that you can prove your shit. So in this case, let's say it's a 9R target. What's the probability of a 9R target with 6.1 pip stop loss? Don't know, let's find out. So we're going to quantify this the old school way. Oh, key point while I'm on this. You can set this so you can have the daily candle and you can have the weekly candle, which I think is really, really useful. How you do it, you just change that to the weekly, and then you just put a duplicate of the indicator, just in case you're wondering how I did that. Anyway, daily candle over here, like so. And we are going to quantify all of our targets with pip availability. So 6.1, let's go get it. Where is it? 6.1. $9R is the target. There you go. 9R is what you hit. Can't make this shit up. There you go. So I'm not going to do the whole... Okay, does anyone actually want me to do it? I mean, I've done it enough times, but I can do it. Do you want me to annotate all of these, or do you get the point of why we took 9R as the max target, which is what got hit to the pip? Thank you. Okay, cool. Because I don't want to do it again, to be honest. Right. But yeah, as I said, the data doesn't lie. The data said, get out at 9R. What happened? You got out at 9R. Then, on top of that, where is the exit window? 3 to 7. You hit your 9R target, get the fuck out. If you didn't, look what happened. You threw away from 9R and you're all the way back to 5. You pissed away 4R being greedy. Right? The data doesn't lie. This is being mechanical. You know when to get in, you know where to get in, you know where to get out, you know when to get out. What more do you need? This is as mechanical as trading is ever going to get in the manual retail space, unless because you're basically trading like an algorithm doing this. This is pretty much how algorithms work. There are rules and a framework that is followed based on statistics. You're just trading like an algorithm. So, yeah, that's that in a nutshell. Let me go back to my agenda. Okay, cool. That's the price action all done now. Now I am going to address Max's question, which is daily bias and what I've been doing. Okay, and then I'll look at the Q&A section and try to address as much as I can, given the fact that I know we're basically out of time, but I am a man of the people, so I will stay around and do what I can. So, daily bias, let's talk about it. So, what have I been doing for daily bias? Right. Daily time frame. So, what have I been doing? I've gone back to my old roots, and I have been using a 10 SMA as one of my confluences. And it's only stuck to the daily time frame. Now, why? Well, one, I can clearly see it works for trends, but I do not use it in isolation. Let me explain. I still trade supply and demand. I just use it as an additional confluence to make sure I'm trading with the trend. But I do know, so I use a combination of three things. I still trade basic supply and demand, meaning I see supply is here. If I am here, I'm looking to short from here. I'm not going to say I want to go long for any other reason. I'm like, I still trade supply and demand, right? So there's that. I use the moving average because it allows me to be able to gauge the trend easier in a non-disputable way. But I still use this in combination with what? Like I said, it's all in context, right? So I use it in combination with this. Why? Because if I'm at a supply or demand zone and it also coincides with, let's say I'm being told I'm at a supply zone and there's a 99% chance of being bearish, I have no reason to long it. So I'm going to, because PA is saying short it, is at the zone to short it, and statistics is saying to short it. So I'm going to go short. And I just wait for my entry model. I wait for PTLR. If it happens, I take it. If it doesn't, I don't do shit. So I use a combination of what I see, this trend like indicator, I guess you can call it, and the data to help me tell a story. Meaning like if I've had 1, 2, 3, 4, 5 days bearish, and then I know there's a pullback likely to happen, and I'm at a demand zone, like so, then on this particular day, I will not look to short again, I will look to long as a counter trend trade. For example, like I said, we are supply and demand traders first, and then we are data enthusiasts second. Hence why this is written in a particular order. Who is in control? Where is the liquidity? Because we want to trade towards the money. Then, after you have all that in line, data doesn't lie. Then you start using data to help you tell the story. But you need these two to write the story. So let me do that again. Yeah. Because this is the main thing that everyone needs to take away from this call. Because otherwise, you'll be using the data incorrectly, putting data first, longing from crazy places, shorting from crazy places, and being really confused. So, who is in control and trading towards the money does what? This writes the story. The data doesn't lie element tells the story. Do not forget that. Very, 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 very important. The main thing you need to remember at the end of this call is that the first two write the story, the last one tells it. If you follow this, you won't have fuck-ups. Does that make sense? I think I've offended the chat. Oh, who died? Awkward silence. God damn. All right. Okay. Right. that covered pretty much everything I wanted to cover. So where's the Q&A for this Q&A? No questions in the Q&A. Okay, so I'm gonna check the Discord now. I hope there's not a seriously long question. I'm tired. All right, let's see what we got. Let's see. Oof. Ooh, where do I start? Okay. Yasin, let's start with Yasin. Aspect of selection of POIs. How I don't understand an important aspect of the selection of POIs, which is how you see a chain. In a video, you say that you want to see a supply and demand reaction, but sometimes I don't see it like you do. Can you enlighten me? All right, let's see what the example is. This is my drawing. Okay, all right. Let's address this. How do I see a chain? So, for me, the easiest way is for so keep in mind there's different ways you can see POIs and price action. Like the supply and demand lens is like, okay, where was the last up move, meaning this, before the break of structure? And a lot of people are like, well, why do I mark out ranges? And then, okay, but you have imbalances and all this other stuff, right? Well, one, why do I mark out ranges? Well, for one, this is on the 50-minute time frame. But then if I go and add all these 50-minute candles together, you can say that's an hourly POI or a 4-hour POI. So it doesn't matter. If I'm marking out several 50-minute candles together, on the 4-hour, it's one candle, right? There's that. Then on top of that, the reason why I mark it broadly is because I know, even though I don't like to admit it, from the ICT lens perspective, fair value gaps do get respected. And they end up being POIs like this when it comes to the 50%. So even in Phantom, you would have seen Blackwatch, for example, say this is a WIMB or whatever the fuck they call it, right? So rather than deal with all of that shit, I literally just mark it out as a zone. Because I like to keep my stuff simple, right? So that explains that. And ultimately, what I'm looking at is I just want to see the argument that structure broke. This was the last up move before the structure that needs to get mitigated. Did it get tapped? Yes. Did we break structure again? Or we formed equal lows, good enough for me. Where was the last up move before that? Over here. Carry on. Did we break structure again? Yes. Where did we liquidate? Or where it needs to get mitigated? Well, this swept this, so this needs to get mitigated to some extent. So I draw chain from here to here, and so on and so on and so on. Right? That's all I do. And just keep drawing the chain until I get a significant break. Now, this is a little bit of a mind bender. I'm going to avoid profanity because for now. And you may say, okay, then does that mean that the supply failed? Well, it depends how you look at it. Could you say that this maybe didn't get mitigated? Don't know. We can go down on a lower time frame. Did it get tapped into properly? Not really. So maybe this is the mitigation. Because I'm looking at this as now that we've had, in the lead up to this, and we had like 6 or 7 days bearish. This is now our reset. But what did we leave in our reset? Relatively equal lows, right? So I'm still bearish bias for this week. I'm not going to say that we're going to go long now for any reason. Like, yeah, we have NFP tomorrow. So we have to be careful. If anything, maybe don't trade, right? But there's still liquidity to be had here. And then the weekly high is here. So if we're expecting an average weekly range, where is it? Somewhere here. There. We're expecting an average weekly range of 174 in December, and your weekly high is here. How are you going to get to 174? 174 is here, right? So let's say, for argument's sake, 174, because it's the weekly average and the data doesn't lie. Let's say 174 is going to happen. What's more likely to happen? Are you going to get 174 hit this way and we only have to go down to hit this? Or are you going to get 174, hit this way, and we need to travel? What is this thing? We need to travel 134 pips in a day to get here. What would you say is more likely? I would say the shorts are more likely, especially considering what's already happening already. And there's liquidity below. And we're still in no man's land. Go on the 4 hour. We're still in no man's land. If we wanted to say we wanted to go for longs still, where could you argue needs to get mitigated? Here. If we want to go for 4H demand. Then if you go boil this down to the weekly time frame again, sorry, the hourly, and then you do the weekly forecast again, 174 pips is where? Here. So average weekly range. And then if you argue you want to mitigate this, potentially, maybe that's where you need to get mitigated. This is me using the data to help me tell the story. So you may make the argument that, okay, if you get a confirmation, NFP could come here to finish the weekly range, because it's far more likely we'll get here than we're going to get to there. Not saying it's impossible, but if you wanted to long, why would you long from here? You'd rather long from here. NFP might do what it did like 2 months ago. It hits this and then it starts traveling up and it starts taking all of this out as what? IRL, because this is all efficient. So the intention, if it hits this and starts flying back up, is not to mitigate shit. It's to take all of this out. And we also have a high probability that the high of the month has probably already been printed, because this is, where's December start? December 1st is here. We're at day number 7. The probability of the high of the month in a bearish month being printed in the first 7 days is as follows. That's if our bias is correct, key point. But we have the data to at least be able to make an informed decision on what we want to do. So day number 7, probability is 50%. By day number 8, which is tomorrow, that will jump to 75%. So depending on what NFP does, will pretty much dictate the whole entire rest of the month. Yeah, we have a break of a previous New York high, so maybe this does get respected. But keeping in mind, this is all in context. Like, I don't just hold on to this by itself. Like, you have to still look at supply and demand, right? Right now, we are in no man's land. This, I can argue, is a corrective pullback to reset the consecutive candle aspect, because now we don't have 7 candles in a row bearish. Now we're back to square one. So then if you want to long and you're a high time frame player, why would you not want to long from here? Especially if the argument is to say that these guys are in drawdown because this break of structure they weren't anticipating. So they need to mitigate this. From a smart money perspective, is my argument. So I'm saying if I'm expecting high time frame longs, what would I want? I would rather have this. Then go long if I'm playing the high time frame game. I don't want a long from no man's land. If I'm in drawdown and I need to sort this out, I want this sorted out before I agree with all the other players to go long. And then the argument would be after that happens, this is IRL. So yeah. Okay. Let's see what other questions we have. I can quickly address before I have to go. Let's see. A lot of these are very individual questions that won't be really suitable, so I'm gonna have to answer these privately. Yeah, okay. I'm gonna answer these individually because these are very, very specific. Oops. What's this? Okay, I'll address, I think I've already addressed this one on the call actually, but I'll address all of these individually because they're very specific. They're not like broad questions. Okay, right. So That being said, what's settings of my kill zones? Right. Wait, which one? The new indicator. I assume you mean this. Yes? No?
Yeah, the ICT one.
Right. Okay, I actually have to go onto it. There. Take a picture, take a screen. I'll put this in the, what do you call it? The tool section. So like everyone will have it because some people will miss the call. So I'll put this in the tool section tonight. So that covers that. Okay, right. So that's time, but I am going to end the call on a motivational note because I had one hell of a week, and through trials and tribulations and all sorts of stuff, it makes you really reflect on life. And I know all of you guys deal with the same hardships and the same issues, and people hating on you, disapproving of your decision to even be involved in trading, disapproving of your decision to do something that they don't believe is possible because of their own limitations. And you always have to remember, you live one life. It's your life. It's you versus you. And I've said this quote before, you're the director of your own movie. So at the end of the day, when it's all said and done, you want to put on an Oscar-winning fucking show. People are going to hate on you regardless of what you say, what you do, what you stand for. Ultimately, it doesn't impact where you're going. You are the driver of where you want your life to go. People will always say what they're going to say, regardless of how you feel and what you do. You can't let it get in your way of where you want to get to. You need to get to your own destination based on how you want to live your life. You can't expect people to resonate with what you do or align with your values. All you can do is just put your best foot forward and be the best version of you at the end of the day. You coming to the charts, doing the work, putting the reps in, going through the drawdown, going through the ups and the downs, the ebbs and flows of the market, the tough times, the days you don't want to backtest, the days that you're getting clapped, the days that you blow an account, the days that you're being drawdown, all these things, they're all parts of the journey. But whatever doesn't kill you will make you stronger. And as long as you're learning from it, just see it as you're paying tax, you're paying tuition to the market. Because at the end of the day, don't forget the end goal. The end goal is you want financial freedom. Because what's the alternative? You work a 9 to 5, do the rat race, go and take your paycheck to paycheck and spend 35 years to pay a mortgage off and fucking die. There's more to life than that. And we all know it. And if we all had a choice, we would all make a choice to do something else, because that's the life that society wants us to believe is normal. But ultimately, if we all had a choice, none of us would want that. None of us would say, when it's all said and done, when we're on our deathbed and we're old and etc., we wouldn't want to say, I wish I worked more. You'll value the time you would have had with your loved ones, the time you had with your parents, times you had with your kids and all this other stuff. That's what really matters. And that's what you're really going to care about. Not how much money you made, not how much hours you put for your boss, none of this bullshit, right? You can't get time back. The beauty of this trading thing being available to us is the fact that we're able to trade this skill for time, because we're able to make vast amount of money in a very short amount of time that we can never even believe, where you're making an annual salary in a day and all sorts of crazy shit that you wouldn't think is possible, because any 9 to 5, even if you're an investment banker, it's not happening, right? But with this skill set that we've, stumbled upon, it's at least given us an equalizer to say, okay, we can challenge the status quo. We can do something different. And it's all dependent on how much work you're willing to put in and how much and how bad do you want it. The ones that fail are the ones that give up. If you do everything you're supposed to do, put in the work and do the shit you're supposed to do, at least with this strategy, it's a data-driven strategy with proven statistical edge. Can't be disputed. What I've showed you, the numbers don't lie, and you've seen it with your own eyes. Once you've seen it, you can't unsee it. So at the end of the day, it all boils down to how much work are you going to put in to train your eyes to see what I see with the data to the point where it's second nature to you. And that's all you versus you. No one is in your way. You decide how many hours you put in. You decide how you're going to do the back testing. You decide how you're going to do the live testing. Because at the end of the day, the market will reveal the truth in terms of how well did you prepare to attack the market on any given day. It's all up to you. Don't care about the next man's P&L or whatever. Care about your P&L, your journal, your results. Because at the end of the day, that's what's going to determine your freedom, how well you're doing, not how well I'm doing or the next man's doing. The strategy's there, the strategy's mechanical, the strategy's plain and simple. It's up to you to execute it. You can do it. Just don't self-sabotage and get in your own way. I just wanted to leave the call on that note. So yeah, that's the end of Lowdown Liquidity. I will get to the rest of the questions at some point during the week. Regarding the data is going to be delayed a little bit because I am very short on resource right now, to be honest. Some developments have happened, so there's a lot more I need to do now than I anticipated. It is possible that the new data will be launched in the course all in one. I'll keep you guys updated. But yeah, just keep active in the Discord chat. I'm pretty active, so I try and keep you guys up to date with everything that's going on. If there is any other changes or any announcements, check the announcement section. Please, everybody, sign up to the wait list. I am giving a bigger discount to the OGs, meaning you guys. So anyone who was a premium member, so everyone on the call right now, you're not going to get a 20% discount. You're going to get a 25% discount. But I still need you guys to sign up to the wait list because it makes it easier for me from a data tracking perspective. But I am going to give the OG members more discount and grandfather you guys in because you guys are loyal and you guys invested in me early before anyone else believed in me, and I value my friends. So at the end of the day, you guys get looked after more. Regarding that, there was something else I wanted to say. I think that's pretty much it. Yeah, you guys get grandfathered in, and yeah, I just need you guys to sign up so I can at least get a gauge of demand and all these other things for forecasting purposes and stuff. Outside of that, yeah, I'm gonna work my ass off to try and get the course ready for February, but it's looking like it might be delayed to March. That doesn't impact you guys at all because you guys aren't gonna you guys are never gonna pay for anything until the course actually goes live. It just means that you guys get free Discord for another month, I guess, until I launch the course. But it doesn't impact you guys at all, really. There will be a quarterly subscription. But the quarterly subscription isn't going to, let me not even talk too much. More will be quarterly, annual subscription, all that other stuff in due time. But for now, all you guys need to know is you guys are getting the best discount possible because you guys were the first 100. Everyone else, tough shit. You get 20% if you sign up. If you don't, there is not going to be a discount because it's a premium product. So yeah, that's that. And yeah, I hope you guys have a good week. Be careful in NFP. We know the statistical likelihood is it's going to be bearish, but that doesn't mean NFP, anything can happen. So if you're not already in profits, don't bother risk it. Just leave it alone. Meaning if you're in profits already, you're risking house money, go for it. If you're in drawdown or whatever, NFP is not the place where you're going to get out of drawdown. Just leave it alone. Come back next week. Don't even bother. Right? That's my advice as a mentor. Don't do it. Don't be stupid. Cool. Thank you everybody for attending. I appreciate your time. And yeah, let's make Project Lowdown, a good course, a good mentorship, a good community, and let's change lives together. Everybody should have positivity. We're all here to help one another. No negativity here. All right. Do my co-hosts want to say anything in passing, or are we good? Dachi, Hassan?
Stay safe, have a good weekend, and
Aaron's still
yeah.
here.
Nah, that guy bounced.
All right, cool. All right. We'll see you guys next week, same time. Peace.